Welcome back to another episode. In today's episode, I'm going to be talking about how I'm allocating my portfolio to reach maximum gains in 2025. So my current portfolio consists of ETFs, which are low risk / dividend plays, such as the DIA ETF tracks the Dow Jones, the Charles Schwab Equity Dividend ETF, and that's around 35% of my portfolio. Then I have Apple and Nvidia, which are slow growers. Apple is around 14%, and Nvidia is around 27%. Then I have a value investment play. I invested in Bowhead a while back, very undervalued stock at the time, and that is 24% of my portfolio. Now my new Q4 portfolio allocation that I'm going to be trying to initiate is around 40% for ETFs, low risk / dividend plays, and I'll explain on that more and what I'm adding to those ETF. Slow growers, around 30%. I'll probably keep the same, Apple, Nvidia, maybe add another one, and then some other value investment plays that I will later explain. So one of the ETFs that I'm going to be investing in is the Global X Artificial Intelligence and Technology ETF under ticker AIQ. I actually just made a recent video on this. I would definitely make sure to go check it out, but I'll do a brief explanation. So this tracks, a lot of AI stocks. The management style is passive and the dividend yield is 0.12%, so they do offer a dividend. Expense ratio is nothing too high, 0.68%. Over the past 3 years, it's had great growth, 168% for the ETF. And this invests in some of the top names such as AMD, Alibaba, Google, Tesla, Oracle, Broadcom, Palantir, and much more. Now their dividend is a little spotty. They do offer a dividend, so that's always a pro. Really the main reason I'm adding on this ETF to my portfolio is due to the fact that AI is just growing to such huge amounts. The momentum is huge, and you got to be careful for single equity plays. The AI industry is very overvalued right now. This is a lot safer, offers the dividend, and the growth has been incredible. In 2023, it had its top year of a 50% increase. Depending how the rest of the year goes, if we don't see a major correction, I definitely think that this ETF will be able to achieve those high numbers. In terms of a slow grower, I'm definitely going to be adding some positions into the TJX company under ticker TJX. They have stores like Marshall's, TJX, HomeSense, and in terms of Q4, that's really where they see their biggest income increase due to the significant increase in sales from, holidays such as Christmas. All their margins look super strong. Gross profit margin, operating profit margin, net profit margin, all are super strong numbers. Revenue, they've been able to increase year after year with that outlier in 2021. But other than that, they've had, exponential increase in revenue. Profitability as well, their free cash flow is declining a little bit from 2024 to 2025, but I think they'll see that, increase with Q4 coming in strong. Balance sheet, total assets are growing, liabilities are growing, but as I always explain, that happens when companies grow, and total equity seems to be, slowly growing, as well as their market cap and enterprise value. They do offer a dividend, and their dividend per share growth, over the past year has been 13%. Over the past 10 years, 16%. Earnings per share growth is super strong as well. Over the past year, it's been 10%. And over the past 10 years, it's been 11%. And revenue growth, obviously that's increasing, over 1 year to 10 years, as well as gross profit margin and operating profit margin and net profit margin. Their net income growth hasn't been that strong in 2025. Significant outlier in, that I believe that was 2022. Really, I'm just primarily holding this company just for Q4. I've seen from the past income statement that, income obviously rises in Q4 as it does for a lot of companies. In terms of TJX company, TJ Maxx and Marshalls, more people are going to shop there for the, holiday season. Price to earnings right now is at 29 for 2025, and that's a little bit undervalued compared to the broader market, the S&P 500, which is sitting at 30. But, I'm not really looking at this as a value investment play at all. This is slow growth and really trading this during the Q4 period. They've done a great job at, buying back their shares, which is always a super positive thing for a company. In 2013, it's been able to decrease to 2025. Now, if we look at their earnings per share growth compared to their peers, TJX company definitely stands out. An increase in earning per share is definitely what drives up a stock price. When you have those negative earnings, people will start panic selling and the stock price will go down. So here we can see, where their PE ratio sits compared to their peers. They're at about middle. They're not necessarily overvalued when looking at the PE ratio. I think they're very suitable at that 31 number, and I don't want to see anything lower for a slow grower. I want to be able to see this number steadily increase, but not too much of a dramatic change. For value investments, I'm definitely going to be looking at NU Holdings. I made a video way back, maybe 6 months to a year ago, on this company. Great company. huge future growth outlook, and I bought a lot of shares in it, and I actually just recently sold all my shares due to the analysts, reporting a price target of around 16. So I decided to, take out all my shares of it, but I got a really good, payout on that. And this is a great example of, if you're very confident in this stock, whether their fundamentals look good or their future growth looks good, make sure to hold the stock if you're super confident with it. I bought it right here, went down, I bought it even more, and then I bought it again. It was somewhat volatile over that 1 year time frame, but it ended up going back up and paying out like I expected it to. So just a brief explanation of NU. They are based out of Latin America, that being Brazil, Mexico, and Colombia, and they offer fintech solution. A lot of banks in this area are traditional. NU was the first one to really bring financial technology to this region, so very niche product, and they have grown significantly. See by their revenue, their revenue has grown really pretty extremely. That slope is quite high. Profitability as well, their free cash flow grew, as well as their net income, and free cash flow is so important for value investment. So later explained through the discounted cash flow statement, we can see that total equity has been growing, total assets have been growing, as well as liabilities, but that's expected. With the, significant decline in 2022, it's been able to regain its market cap and enterprise value. Revenue growth over the past 5 years has been 88%. Gross profit margin really strong, 40%. Earnings per share 90%, which is huge. Like I said, that's what drives up a stock price. And capex to sales ratio, they're using a lot of their revenue to invest more into the company, which creates more future growth. They had an inception point. They were negative in their net income for a significant amount of time, but they came out of that in 2023 and 2024, and they've been able to increase that since. Gross profit margin has looked good through the years of their operation, and operating profit margin, we can see that they came out of that inception point in 2023, and it's been growing since then. Compared to their peers, it's really hard to compare them to any peers because a lot of these peers are based out of the United States. But even though NU is not based out of the United States, they've created themselves as such a strong company compared to their peers in terms of revenue growth and free cash flow per share growth. Right now we can see that the PE ratio for NU is pretty high, 32. But I'm going to take you over to the discounted cash flow statement and see where they value now. We can see through a discounted cash flow statement, their current price is $15.12. Their fair value price is $31.93. So they are still, undervalued, and their discounted fair value is 52.6%. So they're still undervalued. If you look at the discounted cash flow statement, PE compared to their peers, maybe they're a little bit overvalued, but you're still getting a value investment in there. Implied growth rate too is really strong, 14% for revenue, 19.6% for earnings, and free cash flow 14.2%. Their DCF to free cash flow growth looks good too. Their current price is $15.12, and their fair price is $26.03. So you're getting a 41.9% discounted fair value. I mentioned that I sold all my shares, and there could be a slight pullback in the company, but over the long term, and you buy this company and you hold it, you're definitely going to be, paid out a generous amount. Everything looks super good in terms of fundamentals. They have a niche product in their region, and they're expanding. Well, that's all I got for you guys in this episode. Definitely make sure to subscribe and like so you can keep on track with other equities that I may be buying. Hope you enjoyed the episode and learned something new. This is not investment advice. This is all for educational purposes only, and thank you guys for watching.